Hello from Chicago and welcome to Stockcharts TV. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Asbury Research is a registered investment advisor and has been providing both investment research and asset management to individuals and professional money managers since 2005. You can find out more about us by visiting asburyresearch.com or asburyresearch.substack.com. The title of today's presentation is Despite Political Uncertainty, U.S. Market is Poised for More Strength. Today is Thursday, June 5th, 2025. Today my focus is on the big April rebound in the U.S. stock market and what that means for market direction during June and potentially into the third quarter. Despite a steady stream of mixed, if not conflicting messages coming out of Washington regarding tariffs, trade wars, inflation, and interest rates, which have handcuffed many companies from expanding their operations or hiring new people, the market has remained pretty impressively strong, driven by leadership in all the right places. We'll look at some of those places in just a minute. This could be because the U.S. stock market, which at its core is an incredible discounting mechanism, is learning how to exist within the current geopolitical environment by not jumping at every tweet or comment coming over the news wires. Meanwhile, there have been some good overseas opportunities as well. Been seeing a lot of relative outperformance from various places around the globe. First, let's review what I talked about in my previous video on April the 24th for Stockcharts, so we can kind of get a baseline starting point for today's video. The title of that video was History Suggests an Emerging Buying Opportunity. Since that video, which was exactly 6 weeks ago, the benchmark S&P 500 has risen by 11.2%. So let's look at that chart. So this is the S&P daily going back to summer of last year. And this is April the 24th when I was with you last. And we've had a nice 11.2% move higher since then. We're back up above the 50-day, which is blue, and the 200-day moving average, which is orange. They're minor and major trend proxies. On April the 24th, one of the reasons that I was positive the market is because our Asbury Six had turned back to positive. Here's our Asbury Six from that date, actually from 4/23, because we made the video on 4/24. So this had been the most recent one up to that point. You could see 4 out of the 6 constituents, they were green. It means they were bullish, and they were all 4/23. You can see the dates on all 4 of them. So we had a shift in the internals back to a bullish state. So the Asbury Six is a daily data-driven gauge of the U.S. stock market's real internal health according to these 6 pretty diverse metrics, which we selected and put together as a team, so to speak, via quantitative backtesting. Since 2017, the A6, as we call it, has remained dead even with the S&P 500, but with just a 13.6% maximum drawdown, which is almost 2/3 less than the 34% drawdown for the S&P. Also, in our 4/24 video, we pointed out that the huge market decline into early April had resulted in a test of major support at 48.19 in the S&P 500. Let's have a look at that. Kind of puts a lot of this back into perspective. We also had similarly important support levels tested right around that date in the Dow 30 and in the NASDAQ 100. But here is what that looks like. This is a 5-year chart of the S&P 500. For those of you that are longer term traders, these opportunities do not come every day. But what we were looking at is this is the trend line from the COVID low. This was March 27th of 2020. And then this was the benchmark high that we made in January of 2022. Both of those were converging right around 48.19. We got within maybe 20 index points or so, or maybe even a little less than that on April the 7th, and the market took off like a shot. We also pointed out, which was kind of the other half of the story by looking at the support here, is that the AAII percentage of bears and investor sentiment metric was at a multi-year most bearish extreme that as a contrary indicator coincided with most of the important bottoms in the S&P 500 over the past several years. Here it is here. So this is where we were when I was with you last. We're very bearish according to AAII. I've spoken at AAII events all over the country for many years, and their demographic is older. A lot of them are retired. They're typically a lot more risk averse. They tend to have more money. They tend to be a little bit more fundamentally driven. So a lot of this technical analysis is a little foreign to them, but they are older and they tend to get spooked when we have a wicked move like we did going into the April lows. But you can see all of these different lows that this indicator has basically identified, going back a decade or so. This right here was the October 2023 bottom, October 22 bottom. This was the COVID bottom. This was the bottom that we made at the latter part of 2018. So you get this combination of investor sentiment and a big support level that goes back several years, and opportunity knocks. One of the advantages for me of using stock charts is the breadth of different types of data that are available on their service, like this AAII sentiment data. It's not available everywhere. Having access to sentiment data like this lets me know what the market's thinking. Like the individual investors that are represented here, I want to know when they're offsides. And they were freaked out here back at the beginning of April. When this demographic becomes too one-sided, again, special trading opportunities, which when you dovetail them with looking at the charts, it really works well to try to set things up for a longer-term opportunity where there's a lot of risk reward like there was in early April. Now let's shift to what's happening now in the market. Let's look at where is support and resistance. Well, the first thing we want to look at before we go there is let's just go back for a second and take a look at the Asbury Six. This is the Asbury Six through yesterday, 6-4. You can see that 4 of these are green. 4 of these would have to turn red. 4 of the constituents would have to turn red to tell us that the market is weakening internally and we should be starting to play some defense, thinking of maybe pulling back in some of our equity exposure. That is not the case. This has been 4 or more green since April the 24th. The next thing we want to look at is we want to see where the support and resistance levels are. So let's go back to stock charts and let's look at our support and resistance chart. Major support is the March 3rd high of 57.95 and the March 3rd high is 57.87. The 200-day moving average is 57.95. That is major support. As long as we stay up above there, it suggests to me that after a pretty rough move down, that the larger uptrend that began at the COVID lows in March of 2020 has reengaged. The resistance up above is at 61.47. That's the all-time high that we made on February the 19th. The next thing I want to know, where's the leadership coming from? Where can I go to possibly not only be able to capitalize on this move higher, but also capture some relative outperformance? And for that, we're going to go back just for another second over to Asbury Research and go to our CEF model. Our CEF model is a data-driven sector rotation model. I built it 7 to 8 years ago. It was created to quantitatively identify long and overweight opportunities in U.S. market sectors by following the velocity of money as it moves around the 11 sector spiders, which if you put these together, it's the S&P 500. Our top sector is XLK. It's been that way since April the 28th. And since then, let's go back to stock charts and go to XLK. So since April the 28th, XLK, which is the, it's a spider product, it has risen outright by 15%. You can see right here. And relative to the S&P, it's outperformed the S&P by 5%. This is where you want to see the leadership. If you're in a bullish situation and you're wondering how long it could last, this is a healthy place to get leadership from. Finally, the last chart is within that sector. We're going to look at Microsoft. And this chart goes back several years, and what it's showing you is that through today, Microsoft is starting to edge above its previous all-time high of 468.35. You see it right there. Meanwhile, Microsoft has been outperforming SPY, which is the ETF for the S&P 500, since April the 4th. So I am watching closely 468.35. If Microsoft can start to accelerate higher from there, that's going to tell me that leadership that we're getting from tech right now is likely to be sticky. And it could be enough to drag the market higher, or certainly support the market going higher for the next several weeks or more. So there it is. You can request more information about us at asburyresearch.com. We have research services, and also we have managed accounts that we manage via 4 model portfolios that we have created from our various models, like the CPM model or the CEF model. Hope you found our ideas and analysis useful today. Exciting time in the market, and we will see you at my next video for our friends at Stockcharts.com, probably in about a month or so. Thanks very much for watching, and happy trading.